I think for the short term, I think that is an appropriate term. I think China's market is very difficult to invest now. The two big short-term factors sending it down, of course, are the Shenzhen lockdown because of China's zero COVID tolerance policy, and the regulatory crackdown that China's had with them being more interested in controlling the tech sector and making it clear to the world and the Chinese tech sector who's in charge. Longer term, however, when is China tech going to come out of this, I think is a much more difficult question to answer. And that's because the Ukraine conflict has change the parameters of the global economy in which we operate. In 2019, economic growth was the #1 market driver for share prices, both in the US and in China. Today, the #1 driver is geopolitics. If you look at our thematic scorecards for all of the tech sectors, the big themes used to be artificial intelligence, cloud computing, Internet of Things, quantum computing. Today, the #1 theme impacting tech is geopolitics, and the fact that China is increasingly siding with Russia, and may get involved militarily in terms of helping Russia. That means the world's bifurcating into two zones, a US zone and an economic zone, and the Ukraine conflict has just exacerbated and significantly increased the speed of that separation.
For sure, Cyrus. I mean, for better and worse in that Chinese narrative with regard to it putting itself front and center, not just those old thematic elements, but the new geopolitical ones as well. Ben Harburg, we have you now. Let's bring you into the conversation here. If you look at China right now, I mean, there have been multiple times when even I thought to myself, it can't get any worse. It has to show some stability. But it has been months and possibly maybe even years at this point since the downtrend began. Is there any sign that you'd be looking for that you would say, hey, maybe this is now a deep enough value where people can get back into Chinese investing?
I'm not sure if we've hit bottom yet, and I think a lot of that depends on the outcome from the Rome meetings and some of the posturing that China will make in the coming days with regard to their positioning with Russia. The causes for optimism, I would say, because it's tough to be such right now, is one, obviously in a lot of these businesses, the fundamentals remain sound. China remains the world's largest homogenous market. Many of these companies, in fact, actually have cash balances near their actual current valuations. You saw today a raft of upbeat economic data coming out of China, be that PMI, industrial outputs, fixed investment, and retail sales. And obviously, many of these companies are significantly undervalued historically, with kind of an average PE of about 9.5 relative to probably what's about fair at 12. So what gives me more optimism, though, is that a lot of this is under the control of the Chinese government. It's not actually blowing in the wind here. So the Chinese government has a lot of bullets it can fire to improve the economy and stimulate growth. We don't have the same levels of inflation here as in the United States. We haven't printed as much money. We obviously have much higher interest rates. The Chinese government can obviously choose to side with Western powers, or at least remain neutral in this conflict and give some stability to markets in that way. And more importantly, for our view, is this issue of delisting and regulation. The Chinese government can signal that it is starting to have some light at the end of the tunnel and be very clear and predictable around its listing frameworks, as well as which companies will face regulatory intervention. And ultimately, it needs to decide with the United States which companies will be delisted and what that framework, again, is for data security and audits between American and Chinese listed companies.
Cyrus, I mean, Ben brings up some excellent points here with regard to what China can do. The question is, why isn't China doing it? I mean, it's very focused on technology. It's arguably the future for China and its economy. Why is it acting like this, and what's going to prompt them to stop its assault on its own technology companies?
I think China's increasingly becoming more self-reliant. That's part of its five-year plan. It wants to be self-reliant in everything that it can possibly be. So in tech, that means getting more of a semiconductor, especially a high-end semiconductor supply chain. Obviously, there's some areas where it has to import commodities to do that. But I think China, having considered that, as I said, geopolitics, in particular domestic politics in China, is pretty strong. President Xi came out very strong a year ago when the tech regulatory crackdown started. He said social cohesion is the #1 factor driving his decisions. And therefore, I think the regulatory crackdown will continue. In particular, the Chinese government is interested in having a greater control of data and making sure that data can be used by the Chinese government. And it's also interested in directing the decision-making of Chinese tech companies. Increasingly, you'll see Chinese government officials sitting on Chinese tech companies' boards. And what that means is, over the long term, perhaps China's tech market growth is not going to be as great as the US.